well as constant currency, it is indeed a big miss compared to what peers have reported this quarter. But even if you compare it for the full year, the growth rates are lower this time. So while this is Q3, the company has given us the last 12 months top line growth, and in constant currency, it's a growth of 11.6%. Now, this would compare with 13.3% that Infosys clocked in the last 4 quarters, or revenues for the last 12 months. TCS is, I think, a little more than 12%. So HCL Technologies' growth rate comes in third in the pecking order, and despite it being on a lower base. With respect to margins, the company's margins have been in that band of 20 to 22% thereabout. So you wouldn't quibble too much about it, but what is disappointing is that the company had told us in the last quarter that margins in the second half of the year, that's this quarter as well as the next, will be in a band of 21 to 22%. So that was the explicit margin guidance that they gave us, and the company compared to that has clocked in, I think, margins which are lower than that rate. So that is a bit of a disappointment. So margins at 20.7% is lower than the company's own guidance of 21 to 22%, and they have been below their 21% mark for the last many quarters. So, based on what the management told us just 3 quarters ago, that revenues will be better in H2 because 8 out of the 10 deals that they'd signed for infrastructure and engineering are reaching steady state. That's close to maturity, which will give them a lot of revenue visibility, which is why they said growth in H2 will be better than H1, but that's not played out. Growth in Q3 is lower than what we saw in the prior quarter, and that's flowing through into the margins as well. So it's missed the company's own margin guidance. A couple of hits with respect to the internals. One, the TCV, Sonia, as you were pointing out, deal wins typically, or the total contract value, that's TCV. The new deal wins have been roughly clocking in about $1 billion in revenues. This quarter, they've said it's $2 billion. But again, there the argument is that despite seeing such strong deal wins, it's not translating into a revenue growth because your revenue growth is slower than what the peers are reporting. So clearly, they're also, while they're winning new orders, they might be losing out from their existing orders. Attrition has gone up, so that's also not a good sign. So 17.3% would compare with 16.7%. And if you compare it to a year ago, it's a good 1 percentage point increase. So from 16.2%, their attrition has gone up to 17.3%. So that is not a good sign. The reason why their margins have improved is an account of the blended utilization improving by nearly 90 basis points. So that has contributed to the margin improvement. Along with that, you've got the revenue depreciation by nearly 2.5%. Maybe there would have been some reversal or some hit that they took in the prior quarter because of Chennai. That headwind was not there this quarter. All these factors would have aided the margin improvement. But overall, based on the internals as well as the headline numbers, this is a significantly poor performance that HCL Technologies clocked in. And this is a company which is to grow at a very fast clip. And now clearly they're facing some growth challenges. Let's see what the acquisitions throw up for them in next year.
All right. Thanks a lot for that, Reema, for rattling off all those numbers. Clearly, it's subpar on all parameters compared to